Good morning, everybody. Great to have you here after probably a busy day and a busy day ahead. So we're really happy to speak to you about royalty monetization, royalty financing. Together here with Hannah. Hannah, maybe you can talk a little bit on your practice in
Sure.
Boston.
Good morning, everyone. My name is Hannah England. I'm a partner in the Life Sciences Group at Ropes and Gray, which is a law firm based around the world, but I sit in Boston. My practice focuses on royalty monetization, licensing and collaboration, and other big partnerships, working with a lot of European companies, especially on structuring royalty deals on from a cross-border perspective.
I'm a partner at Avance, as told. So we're a Basel-based life science advisory firm. We do valuations, licensing, and financing. And as you guys know and experienced over the last couple of years, financing has been tough in the recent years. And so we have been looking for the last, let's say, 5, 6 years at alternative ways of financing. And royalty financing is one of those. So we will speak the next, let's say, 15 minutes on what royalty financing is, how you can use it, maybe how it can be a financing alternative in the future if you're now considering to out-license or partner your programs. So let me first start with what it actually is. So Hannah, maybe you can, from a legal standpoint, talk us through what's actually happening here and what people do.
Sure. So what we have on the slide here is what traditional royalty financing, and sometimes you'll hear people talk about royalty financing versus a synthetic royalty financing. So from the highest level, and this can go in lots of different directions, a traditional royalty financing arrangement happens when, for example, a biotech partners with big pharma. They have a license agreement. They're getting paid milestones and royalties, and typically this happens in the later stage assets, things in phase 3 and beyond, potentially things that have already been commercialized. They turn around and sell some or all of that stream of milestones and royalties to a royalty purchaser in exchange for upfront cash. These transactions 10, 15 years ago were pretty simple. They typically involved the sale of all of the milestones, all of the royalties. Today, what we're seeing is a lot, like most transactions, a lot more creativity, a lot more flexibility in how you structure those. But fundamentally, those are the background dynamics of how royalty monetization works.
So next to why it is a good idea, it's also just an opening another alternative. So we see many clients next to equity financing look for non-dilutive alternatives or additions to what they're currently raising. So next to, let's say, straight equity, they look to sell part of their royalties, which can be a part of the milestones, which can be part of the royalties downstream, or a combination thereof, as Hannah mentioned. And so there are a few reasons and drivers why it would be a good idea to at least think about this alternative. You may have seen it. So Deloitte and Royalty Pharma being one of the founding fathers of the actual space, did a survey, particularly in the US, on why people consider royalty financing. And here are a few of the highlights, which, first of all, it's non-dilutive. So you're selling actually a future portion of your future revenue. So it's an off-balance sheet item. It's not that. Typically, there's no collateral. You keep control. You don't have to give any board seats. So it's really a let's say lump sum transaction. Although you can, as we just mentioned, be creative and also structure it in milestones. But that's the fundamental idea. And also, as pointed out on the right, what makes it different if you sell equity, you basically dilute over all your programs or your platform, especially if you're a platform company or biotech with a platform, you dilute over any future upside. Whereas here you can tailor it to a specific transaction, a specific license, a specific program. So you can basically tailor it to what you want to have in scope or out scope, and whether you only want to sell portion of the milestones or portion of the royalties or portions of both. So that makes it a nice instrument, and you can basically paint it however you like. So that's I think a summary of why people consider it and would be a good idea. Anything that we're missing here, Hannah? I'm just thinking out loud.
No, I mean, I think this slide provides a really good example of why we're seeing such a growth right now, especially given the challenging equity markets in the U.S. and otherwise. Nothing is truly non-dilutive, but it does provide an additional source of capital. It can be a fairly flexible and useful tool, whether a product is already on the market or you're looking to bridge to the next value inflection point. The size of the checks can also vary a lot depending on who your investors and royalty aggregator are. And what we're seeing is a lot of new financing and capital sources coming in, funds being raised. There was the traditional Royalty Pharma, Sagard Healthcare Royalty Partners. Those are sort of the bigger names that tend to write the bigger checks, but we're also seeing a lot of earlier stage investors that are coming in. One of the most common questions I get asked is how early would an investor be interested? And you may also hear earlier stage clinical trial funding agreements called product financings, trial funding. They really operate like a synthetic royalty transaction the later stage. And those are where we see a lot of growth, a lot of new companies that we're working with on the investor side to partner with our clients and come in at an earlier stage than has been more typical a few years ago.
Yeah, so we see a big rise in interest in the industry by investors and new funds coming in. So currently we actually see a handful of institutional investors exploring to deploy more funds in this space. So if you look at currently, it's about 9 to 10% of the overall biotech financing comes from royalty financing, which is still very small fraction, but it has grown a lot, as you can see from this slide. So it becomes more and more mainstream, and as with all, let's say, financial engineering solutions, it's very much more advanced in the US, but we see more and more interest in Europe as well, and we try to educate people on the opportunities of these new instruments and how you can utilize it to finance your developments. Key takeaway is it is growing, and it will be more tailored to the various stages of biotechs that you have. From to your question, so the earliest that we see that people can be interested is as of phase 1 clinical development with a good licensing partner. That's the earliest that it becomes of interest to investors up to commercial stage. This is a little bit what Hannah already alluded to, a distinction between traditional royalties, and that's the first slide that we showed, the typical selling a portion of your license agreement, royalty financing versus synthetic. And synthetic is basically with a traditional royalty, you sell future revenue you're already entitled to on a contractual basis with your licensing partner, whereas synthetic is you basically creating a new payment stream. So on your future revenue, whether you're already on the market or not, basically you're saying, well, if you give me money now, you get a portion of the future proceeds of that program. And that can take many shapes and forms. So Hannah is a specialist in that, so maybe you can give us an example on how that would work.
Sure. These can vary by territory. It may be that your company is only looking to sell your revenue stream in Europe. Potentially reasons for that is if you're looking for an ex-European partner. Same thing in the US. You may sell a stream of revenue that you're going to generate in the US and preserve the royalty stream for a licensing partner outside of the US. Other ways that these can be structured is a combination of a synthetic deal. So we would sell 5% of the revenue stream in Europe. And if you already had a rest of world partner, you could also couple that with a traditional royalty financing on the revenue streams that you're entitled to. I think that, we're seeing a lot of flexibility here. This is also on the product financing or the clinical trial stage agreements where you may have investment in the clinical trials in exchange for royalties, whether that's in the US on a worldwide basis or in other jurisdictions, once the product hits the market, and the investors are willing to take that risk in exchange for the downstream payments.
So one key element that I think is good to or framework to keep in mind is that basically the earlier you are, the more discounts investors will apply on your future revenues. So that's very good to bear that in mind. And as you can imagine, let's say a phase one will have a pretty hefty discount on the future revenues versus something that's on the market, which has, let's say, roughly a discount of 10-15%, depending on who the royalty aggregator is. Whereas if you go pre-approval, that can be 25-30% or more, depending on the risk level. So that gives you a little bit of an idea that, let's say, all the biobucks that are in your contract are not nominal value of what you can actually monetize. So that's one thing to, I think, bear in mind. We will be launching a website called royaltymonetization.com with a calculation module on that will be probably live by the end of the year. And you can start calculating on what the actual value would be of one of your programs, so that you have a little bit of a bearing on what you're looking at in terms of financeable capacity.
And I think on that, to pick up on Jasper's point, the other question that we commonly get asked is, what is the downside? Is this too good to be true? And I think that to keep in mind, the earlier the royalty aggregator is making the investment at phase one versus you've already filed for approval is the covenants on the legal side. And obviously there's going to be more restrictions in how you partner, that it tends to even look more like a license agreement where you have development plans that you may need to adhere to. Your partner may want to participate in your development program, have advice and committee structures and things like that. And so the earlier these transactions happen, the more to expect in terms of restriction, oversight, and things like that. Now, that may feel comfortable. It's part of the reason that when we talk to clients about this, getting to know your partner, especially in a pre-approval financing transaction, there will be a true partnership and an expectation of the investor of being pretty involved. And that increases the earlier that the transactions happen.
Yeah, so we summarized a few of the critical success factors, and I won't read them out loud to you because I think that speaks for themselves. But I think to your point, it's a good point. It just as your licensing partner, the royalty aggregators you can see as your, let's say, financial licensing partner. So if it's a synthetic, it almost is as concluding, as oversimplified, but it almost is the same as concluding a licensing agreement, where it's very important to have people like Hannah making sure that you retain the flexibility. And if you already have a licensing partner, then it becomes a, let's say, more financial transaction, but still it's good to have aligned views on potential exits, potential launch dates, but also have aligned views on likelihood of success and their market shares. So what's the competition? What would be the uptake curve like? And they may have a more conservative view than you. So those are the things that typically we work on to align before you actually are able to transact and let's say collect the money. And there are clever ways of structuring that. So I think we get maybe to some practical tips, which Hannah can speak to as well. I think one of the key things, Hannah, maybe before we jump into these is, let's say if you're about to out-license your product, how do you make sure that you have this optionality in the future?
It's a good question. There's a couple key things that if you are thinking about a downstream royalty transaction after your license agreement that are going to make it much easier. These tend to be around thinking about information sharing. What is my investor going to want to see about the programs once I've licensed them? What are the audit rights? What are the assignment provisions? We're talking about assigning payment streams. And so from a legal perspective, thinking through the top level items before you enter into the license agreement. If you've already got a license agreement in place, you hadn't been planning to do a royalty deal, it's still very possible. But if you do know in advance that before you sign the licensing transaction that you will be looking to turn around and participate potentially in a royalty financing, those are some of the things to keep in mind at a top level that can make it much easier down the road.
So the other things I would like to highlight is, and we see that a lot, is be very clear on how much money you would like to raise typically we see companies say, well, as much as I can get, which is hard to work with for a royalty aggregator because they want to calculate their return, etc. So be very specific on what you're looking for, and start timely as well, because these processes take some time. I think the quickest we've seen is 3 months, but let's say 6 months is more normal. So yeah, be timely, and also make sure that you have enough runway before you enter into these discussions.
And I think knowing what to expect to the timeline point, one of the things that when we work with clients on royalty deals, they are sometimes surprised by is the level of diligence that an investor will want to do. And that is partly what drives the timelines on these deals. It's very similar to other transactions. Just like in a license agreement and an M&A transaction, the investor is really going to want to understand in particular the IP, the supply, the regulatory situation. And so having a well-organized data room, expecting that level of diligence can make the process a lot smoother from the start.
I hope this was very clear. If you ever consider, let's say, this type of financing or matching your current round with these options, feel free to reach out to Hannah or ourselves, or check out royaltymonetization.com. And we hope you have a great rest of the conference. Thank you.
Thank you.